Home Depot holds its investor conference today at the New York Stock Exchange. The home improvement retailer is reaffirming its guidance for fiscal 2023. This is lowered guidance that they first gave when the company reported earnings last month. They expect sales and comp sales to decline somewhere between 2% and 5% compared to fiscal 22, and earnings per share to drop by 7% to 13%. I spoke to the company's CEO, Ted Decker, ahead of the investor conference about his plan for the business, including how to grow when consumers are shifting from buying things like they did during the pandemic to spending on experiences. We sat down at a Home Depot store in New Jersey.
We had explosive growth, as you knew. During the COVID period, the Home Depot grew $47 billion, 43%. Just spectacular performance. We grew our EPS 60%. So we always knew this year was going to be a bit of moderation for the home improvement market. Principally, the consumer, I think, is still in pretty good shape. But there was such a shift of spend from services to goods, and particularly home improvement goods, over the prior 3 years. So we knew that there was going to be a period that spending was going to shift from goods into services. And we're going to go out and talk about the future of Home Depot, the future of the consumer, our marketplace that remains super strong, and how the Home Depot is going to continue to focus on growth. We think in a stabilized base case, we can grow the top line 3% to 4%. Grow EPS mid to high single digits. And then as some of our investments come online, satisfying the larger pro purchase and continuing to take friction out of our consumer shopping journey, we can grow even faster than that 3% to 4%.
When do you see the market stabilizing? You're talking about a stabilizing home improvement market.
Yes.
And that's not what we have right now.
Right. And the short answer to that is we don't know. And as we went into 2023, we thought the market would be down low single digits, and we could, fight for share. We always try and take share in any environment, but fight for share and get to a flat comp. We knew there was going to be pressure in lumber, and then unfortunately we had a pretty tough late spring through much of the country. Plus, watching the PCE shift from goods to services continuing, we said, this is going to last certainly through 2023, and we updated our guidance and said our comp sales are going to be in the range of -2% to -5%. And the difference of those two ranges is just how much that PCE shifts. It's an imperfect science because we're talking about $18 trillion of consumer spend, and we're looking at basis points, but directionally, we think the thesis makes sense. So we purposely said for the investor and analyst conference that, we're not going to call when this moderates. If you tell me what the Fed's going to do and what are they going to do Wednesday and how much are they going to do and are we going to have a recession or not, we want to focus on the long-term investments in the company to take share with our consumer and pro customers. And that's why we went out and talked about a stabilized case, which could it go into 24? Certainly. Would it go much longer than that? As we sit here today, we wouldn't think so.
A few weeks ago, you said that it wasn't consumer weakness as much as it was project size that really dropped. Is that a trend you're still seeing in the stores?
Yes, it's hard to put your finger on it. How much is pulled forward? How much is some inflationary sensitivity? How much is some concern that you're just pulling back? Larger discretionary items that aren't really a need. So we're sitting here in patio. These are beautiful, but it's more of a discretionary purchase. Grills are over here. Maybe I can get through one more year with my grill. Maybe I bought a grill 2 years ago in COVID. Appliances, there's a break fix replacement cycle in appliances, but there's also an upgrade decor orientation of appliances. So we are seeing more of the break fix replace than upgrade, and a little sensitivity to these single larger priced discretionary items.
You mentioned earlier that tell you what the Fed is going to do, and then you'll tell me your outlook and when you think the market will stabilize. So the Fed's meeting this week. If they pause as expected and then raise once or twice, as the market is kind of expecting or baking in at this point, what does that mean? What's your outlook for the housing industry right now?
So we think long-term housing, we're super bullish. And the principal reason is there's a fundamental shortage of houses in the United States. When you think back to the Great Financial financial crisis in our recession in 2007, 8, and 9, a lot of that was housing initiated. There's a lot of speculation. There was overbuilding, no doc loans, et cetera. Fundamentally different right now in housing. People tend to have fixed rate mortgages. 80-odd% of those are under 5%. It's actually one of the issues with the supply of housing in the market. Because some people have 2.5% 30-year mortgages. Right. Interest rates, if I expect they will go up, maybe not Wednesday, but I would expect they will go up. You're going to have higher mortgage rates, and that will have more of an impact on new home construction in sales. But we look at a fundamental shortage of housing of anywhere between 2 and 4 million units. You're looking at 10 plus years, even in the best case example, to get the supply and demand imbalance in housing.
Higher rates is actually good for you in terms of...
I don't know if I'd say good, but it plays out to this dynamic of people staying in place and remodeling. Another thing that this shortage of housing has done is it's increased the value. So you think of our customer base again, tend to have someone with a good job. Our customers' household income tends to be 35% higher than the U.S. as a whole. Home ownership at 80% is higher than 65-odd% as the country as a whole. Home values at $450,000 of our customers is well above the national average. And they've seen this asset, which for most of our customers is their single biggest financial asset, certainly. In the last 3 years, home values have gone up over 40%. So that's $13 trillion in that asset class just in the last 3 years.